Good afternoon, everybody. This is our February 18th GoldFields macro meeting. Today we celebrate the last half-day holiday of Carnival in Brazil. We have a lot of stuff to talk about. And we'll begin with what happened last week. Last week we had a solid January employment report, which eased labor market worries. But at the same time, we also had downside surprise in December retail sales, and this helped recouple spending and labor income. So market is still mindful of this employment situation because of AI disruption. Inflation was in line with expectations. Running rates are slightly lower than where they were before. The market is happy with that so far, but it wasn't as much as feared by the market, okay? So, and this week, now on Friday, we'll finally see the fourth quarter GDP, strong forecast, 3%, remembering that this is real growth, this is nominal plus inflation. So if inflation is 2.5, nominal is going to be 5.4, 5.5, something like that, which is very strong for an economy at the size of the US, okay? During last days, we've seen this, a lot of people talking about AI disrupting white-collar jobs. So stocks that are linked to that, for example, insurance brokers, people that use their skills to how can I say, provide services to clients may be disrupted by artificial intelligence. Okay, even Microsoft, some software makers, they fell heavily during these days. They are trading now at 23, 24 times earnings, which they haven't done for a while. And rates all over the world came down, probably because of this deflation expectation caused by possible unemployment. But I still don't buy that opinion. I think that AI, it has been helping me out. It is a very good tool, but you cannot just sit down here and say, write me a presentation, a macro presentation, need this, etc. I tried doing it once. You still have to instruct piece by piece, structure like a code, like you had to structure a code a while ago. We still have to structure. The difference is that you use human language. Say, I need this benchmark combined with that. You're going to do a spread, etc., etc. So things will, in that way, things will work out, but you still have to have a very organized thinking, okay? Tell the machine what you want it to do. So I'm a little bit skeptical of this huge disruption market is talking about, but let's see. Okay, I could be wrong. Okay. So we still have for USA the base case and risks. We have a scenario which the most probable now, I would say 50%. Upside scenario where Fed cuts rates while inflation remains in check and growth is resilient. The base case scenario, economic weakness and Fed to continue rate cuts. It is not my base case scenario because economic activity has been surprising on the upside. And the downside scenario now, the less probable, which would be bearish for risk assets, is where the Fed is cutting despite inflation picking up and the Fed loses credibility. Okay, I would say this is like 10 to 15% only now. We always follow capital wars, used to be cross-border capital. Michael Howell does a wonderful job following market liquidity, and risk markets now are sending a clear signal. It's the end of easy money, right? After spectacular 3-year run, risk assets from Bitcoin to high growth tech stocks are skidding. This isn't a coincidence. It's a direct result of fundamental shift in the most powerful driver of financial markets, global liquidity. Never forget that. Okay, global liquidity is a leading indicator, so we don't try to forecast it. We just see how it's behaving and derive the behavior of other assets from it. Okay, we try not to forecast it. Of course, politicians and central banks can change global liquidity situation, allowing more leverage by banks or doing QE, you name it. But uh, we we don't try to forecast it. We just follow it. Okay. The U.S. The Federal Reserve is now with Kevin Walsh talking about reducing the balance sheet. We think this is going to be a long discussion. He worked in 2008 at the Fed as a governor, and he says he was in favor of reducing QE before they actually did in 2015. He was already calling for it to stop in 2011. But anyway, if one was to reduce the balance sheet for real, they would need to provide a new regulatory framework where private banks would buy debt and assets from the Fed, so they would be allowed to carry more leverage in their books, and then the Fed would be able to reduce it. In other words, the private risk that was transferred to public banks in the past would come back, and then the risk will be on the private side again. What could happen? Could we have a crisis again in the future? I think in this situation, you would have to clarify for account holders, people who park their money at the bank, say, listen, we have this new situation. You check twice or maybe four times which banks you're giving your money to, because if they fail, there will be no bailout on top of FDIC limits, okay? This could be an idea. And then you give back responsibility, take it from public side, bring it back to private side, which could be fair, but I'm not sure if it's feasible, okay? So let's go to Liquidity Watch. Cross-border capital says that we are at an inflection point, moving from a cycle phase dominated by monetary stimulus to one where liquidity is drying up. We're going to see heightened volatility and repricing of long duration. Investors should proceed with caution, especially if you consider that there's 9.6 trillion of treasury debt maturing in the next year or so. So this is slightly dangerous. There has been some money entering fixed income funds, matching those debt rollovers. But anyway, still we are walking on thin ice. Okay. Especially with liquidity being reduced, we have to watch it. Here we have the overnight repos, private collateral against public collateral. Everything is fine again. Fed injected end of year Christmas present, increased bank reserves, increased liquidity, so they solved it. But BTC, our canary in the coal mine for liquidity, is showing that risk assets are suffering with the liquidity may be reducing. Yeah, indeed. The reverse repo is now almost zero, which shows that money has been put to work, it's not parked at bank reserves anymore. And here they are, the bank reserves. End of the year, the Fed gave us a Christmas gift, sending them higher by probably doing open market operations. But now they are tad lower. But so far, we are not seeing any stresses in the market, so let's move on. M2 numbers were released. We are running at 405%, which is subpar growth. It is positive, but as I said, subpar. The This is probably one of the reasons why current inflation is low. And if banks are not allowed to improve their leverage and this doesn't grow to 7 or 8%, inflation is probably staying on target. But if this goes to 6, 7, 8%, then we'll probably see inflation creeping up, okay? Consumer inflation. This is monetary inflation. Total bank credit, the highlights here. Last data, I don't know if it's just a blip or last data was stronger, almost on the more than 6% total credit in the system growing. So since the economy is nothing more than bank credit circulation, in circulation for buying goods and services, I think that one of the reasons the GDP might be strong is this. The banks are supporting the economy. We spoke last week about total debt and balance and its composition. Well, this is an interesting graphic because we adjust gold by the M2 money supply for US. It shows that at 5,000 or near 5,000, we are approaching 2011 levels, which may be a resistance. We can see that it is wandering around that area. It's trying to go through, but it's going back and forth. So it's testing this area. We may see some real profit taking here. You will be buyer on dips towards the 3,600 level, okay? Have to wait a little bit. DXY. So a lot of talk of Trump and US authorities calling for a weaker dollar. Last week after the unemployment numbers, I really thought that dollar would get stronger, but barely moved. We're still in the 97 levels for the DXY index. So I think that if we don't break the 100 level, there won't be any stress here soon, okay? So here on this front, market is very calm, and bids for emerging markets and hard assets will be there as long as the dollar is weak, okay? Talking about probabilities for next meeting, almost done that the Fed is not moving, but for the end of the year, last week we had 22% of lowering just one quarter and 6% of doing nothing till December. And this week it is a tad lower, 18.8% for a quarter and 4.2% for not doing anything. So distribution is skewed to the left a little bit. It should be bearish for the dollar. Not so bearish, but slightly bearish. The Atlanta Fed GDP after retail trade, as we mentioned at the beginning of the meeting, slightly lower, reduced from 4.2 to 3.7, but still a strong number, right? And if you look at Fed staff nowcast, it is on the 2.7 area, which is the most probable scenario for them. And this means that still is a strong number because this is also real GDP, okay? So it's GDP on top of costs, on top of the deflator inflation, okay? Your disposable income, no updates, still grinding higher. Leading economic indicators going on the other direction, but not enough to cause a recession. And here we have the current inflation numbers for February. We still expect CPI going towards 2.5. Same thing for PCE, but for January the PCE is still a little higher. In December, which is going to be released on Friday. So, but you can see in general the trend. You can see here the trend is lower, okay? For current numbers, let's see what's implied. What are the implieds doing? Well, the implieds are also going lower because nominal rates came all the way down from 425 on the 10-year to 407, 18 basis points. That's a big move. And the tips, which are here is a nominal rate from 425 to 406. The tips moved from 195 to 180. Here we like buying tips around this 2% area. And we are trying to create a fund that will buy tips and sell covered calls on it, which I think it's a good yield enhancing strategy on a good asset, okay? Now that gold and silver have exploded higher, I think this one is a last good opportunity along with some real estate, but more here in emergings than in US, which looks expensive to me. Credit spreads have been behaving very well. They have gone up a few weeks ago, but nothing to scare. And last week it is low, tad lower. There's nothing much to see. Okay, the junk ETF also rolling over its moving average. If it breaks, then we might see some nervousness here, but so far so good. The week ahead. Thank you, JP Morgan, for this calendar. We have FOMC minutes. We have auction of 20-year bond, and we also have some big auctions tomorrow. 5-year note, 70 billion. 2-year 5 FRNs, which are floating rate notes, which I like a lot to use as collateral for trading. 7-year notes, 44 billion. So you see, from now on, we're going to be seeing bigger and bigger auctions because of the size of the rollover. And finally, on Friday, we observe real GDP, personal income, important numbers, real consumption, core PCE deflator, manufacturing PMI. So those are important numbers. We'll probably see some changes in the GDP forecasts looking forward, okay? Equities. We are on this week, so almost all S&P companies have reported. And I've read on JP Morgan research that out of the 66% of US companies reporting, 77 are beating earnings per share and 12% earnings growth, which is a lot because beginning of the year, the expectation was 13%, but the market was skeptical, but it is materializing. So it's 12%, and companies beating sales 65%, and 9% of sales year against year. Those are big numbers. 9% is even bigger than the monetary base. It's amazing to see. In Europe, it is contracting, but slightly still positive earnings per share growth. This is a slightly lower number. US is still the highlight. Anyway, equity strategy, we like to look at JP Morgan because they are a big bank that influence a lot of the big funds. So they say they have entered the year running overweights in value in the US, small caps, high beta, emerging markets, and international stocks. So one of the reasons for Brazilian equities going up is that foreigners have been buying, including Steven Druckenmillers, who bought some AWZ and some calls, according to his latest feelings. I think it's 13F feelings. And they believe that these allocation skills should stay in force. Well, we believe it too. Market will be buying on the dips here in Brazil, probably. And so to put things in a nutshell here, as long as the dollar is weak, bullish trend remains for emerging markets, okay? So MicroStrategy proxy for liquidity and Bitcoin still suffering as liquidity is is being reduced, is reaching a plateau. This brings us some concerns. We know that February is a slightly negative month on average, and the S&P is actually now rolling over its averages, which is not, it is not to get scared, but it's not also not very encouraging. Could be those averages could act as support, but if they breach them lower, the market is going to probably accelerate on the downside. Okay, so be watchful. We've been hearing about big names, big investors buying puts on the S&Ps in size. Whenever this happens, you have to be mindful. Okay. S&P divided by gold, still cheap because gold keeps grinding higher. The S&P doesn't go anywhere. Regarding bonds, the bonds moved a lot higher last week, so the ratio closed a little bit. Still very high. It has been a big ride where interest rates were not able to influence equities. This is America's strong trade, strong market in equities with high rates, high economic growth, unstoppable. Okay. IWM Russell 2000 ETF still bid, still over its moving average, rotation trade. The big banks KBWB index suffered a little bit because if white collars lose their jobs, they may not pay their debts. So are banks going to suffer next? Maybe. Regional banks are still very well bid. Home builders is a highlight on the upside. It has once again tried to break higher, probably because rates moved lower. So here, this part of the economy seems to be doing okay. Walmart, big retailer, also near its highs, spells good for the economy, the real economy. The S&P is reaching its tops of the 2000 bubble when you adjust by money creation. Does it mean it's going to crash? No, but it's just one of the alert signals that we may have to look at. Because everything is priced in money, right? So you have to think that if things get pricey, they may not be as pricey as they could be if there's a lot of money sloshing around. Okay. Nominally, yes, but in real terms, not. So we have to adjust and look at it. PIX on the 20% area shows us that the market is in the middle of the range. I would say that it is stressed and sold out only when this breaks 30 on the upside. I wouldn't do anything here. Realized correlation has been going down, and the implied correlations follow. This is a typical market where the market is working on a plateau, and then players are trying to stock peak to generate alpha. So the market is all the time some sectors going up, the other sectors going down, and this brings implied correlation and actual correlation lower. 15% is still a very low number. Brings us some concerns because if you look at history, 15% we are here is still low. It is not as ridiculously low as it was in July 2025 when we said we might see trouble ahead before a big sell-off. But still is a low reading, so I will be careful here. Okay, so for US, liquidity in dollars diminishing. current inflation going lower is good, liquidity diminishing is bad. Good numbers for actual earning per shares, good operating numbers for companies, it is good, but low implied correlation, it brings us some concern, which is a very good contrarian indicator. So here, there's not much conclusions here. I wouldn't be heavily long at these levels. I would wait to buy on any dips if the VIX pops higher than 30%, perhaps. Have to be patient here, okay? There's nothing that shines in front of our eyes as a big opportunity here, okay? Let's talk about the rest of the world. We mentioned that the IDA's disruption trade was bringing yields down. This is the yield for Italy, is reaching a support here at 335. France, the same. We were skeptic. We were afraid that it would break the 360, 365 levels that would open a way for new highs, but then it reversed, and now it's testing a big support here. Then we move on to China, which is also, bond yields have also moved lower, 180%. They're still having some deflation problems. China, a little bit like the US, technology side is growing rapidly. The old economy is struggling. We will see later that iron ore is suffering today. So rates keep moving lower and sideways, okay? The currency, because they have such a huge trade surplus, keeps appreciating. This opens room for possible monetary and fiscal stimulus, because it would be a way to do something to help the population, and also try to stop the currency from appreciating, okay? Would make two things with just one attitude. Chinese stocks suffer a little bit today, but still trading at a high level, still bullish. You see, this is iron ore I spoke about a few weeks ago, was trading at 820 yuan. And now it's trading at 746, big drop. There is some support here, but we could see the 700 level. Our buyers are probably going to step in, okay? Here's the Fed measure of a dollar against a basket of currencies, which is more skewed with emerging markets. Not like the DXY, which is heavily skewed to G7. It is not going anywhere. We also like to look at the region krone versus euro to see if the market is having any issues with the oil prices. If the markets expect oil prices to collapse, it would be natural to see this rate going up, the krone losing value against the euro. It is happening exactly the opposite, okay? We have been of the opinion for a few months already that oil was too cheap against the other commodities, and it would probably stay there or go higher. It is working so far. We've heard that sovereigns, probably looking at these ratios too, are buying, especially China and the US. So this surplus is not staying in the market, and so there's no surplus at all, okay? UK also closing rates moving lower. British pound, after this big spike, going to first support at 135.5. Germany also lower rates. DAX, like the other indexes in Europe, still very well bid. And the euro sideways, like the British pound. And Japan. Japan is another thing. Prime Minister Sanai Takaishi was also re-elected, and she had a decisive electoral victory, uh, shifting focus toward accelerating budget deliberations and implementing the trade agreement reached with US President Donald Trump. Okay. So equities there are very bullish on this because the party is considered to be center-rightist, more reformist, market-friendly, as we could say, and rates stopped gapping higher, and equities received a bid on that. Okay. Still, GDP came back slightly positive, but lower than expected. The monetary base is still shrinking, so it will be equivalent to it is saying that the POG is doing some tightening, some QT. So rates, probably because of the tightening liquidity, the rates have been going up day after day after day. And now with the landslide victory, they went down like almost 20 basis points. But if this starts creeping higher again, the market will probably get nervous. Okay. The currency, a lot of good analysts saying that it was too weak, and authorities threatened intervention. It collapsed to 152. It seems that this 152 is an area of support, and then came back again. Another talks of intervention came down. Now it's trying to creep higher. Trading now at this moment 155. So we are here. If we break this 158 and go to 160 something, the market will probably get nervous again. Okay. Equities. This is an amazing graph. Is like a textbook breakout and consolidation break. This is very bullish. You cannot be in front of it. Exporters are doing well in Japan, competing with China. And we can see here oil got a bid this year. And if you adjust by gold, oil is still very cheap. It's almost at the 20. This is the 2020 lows, and this is where we are. And this is where we could go. This is like doubling the price. With silver, oil made new lows, and now it's correcting, but because silver dropped. Okay. Gold now is ranging, is wandering around this 5,000 area. We saw on the money supply graphic that it is slightly dangerous area to be long. Would be buyer at this level, okay. Oh, but they are so far away, it's never gonna go back there. You know, the markets are like this. When you don't expect things to happen, they happen. So wait and be patient, okay? Silver, amazing one-day move after Wash nomination, 30% drop. It was going up probably on speculation, and then players got caught off guard here, and there was this huge move. Copper, Dr. Copper, still very well bid. Electric grid and still in demand. Still not moving anywhere, very related to old economy in China, which is not doing well, so no bid for steel. Oversupply, overcapacity. Aluminum is doing better because aluminum is a cheaper proxy for electrical conduits compared with copper. You can do some stuff with aluminum, so it is a bid. And soy is very important for Brazil. It's the second largest item in Brazilian exports after oil, crude oil. So this is good for our currency, even though it is depreciating a little bit today, but it's good for us. And wheat, which is good for wheat exporting countries like Argentina, USA, but wheat is important because if prices of wheat spikes higher, it causes inflation in countries that buy it, like in the Middle Eastern countries, and we see a lot of unrest when food prices go much higher. So wheat is like a powder keg. Uh, but so far you can see that historically speaking, it is still very low price, so everything is fine here, okay? Brazil. Well, for Brazil, the bad news is that the government is talking about the populist measure, reducing people are allowed to work 5 days in the week, and on Saturday, half the day. And the government is trying to pass legislation which says the end of the 6 to 1 journey, 6 days working, 1 day resting Sunday, transform it to 5 to 2, and that would be mandatory. Okay, this won't affect some sectors like government employees that already have lower our hourly schedules weekly, but some other areas which are high intensive uh, in workforce hours, we could see a reduction of 15% and 15% increase, especially for commissioned salesmen. This is going to be bad. They lose 1 day where they can go work and earn their commission. I think this is a negative one in the end, okay? It's a populist measure aiming the presidential elections. Talking of presidential elections, Jair Bolsonaro is still moving higher, market-friendly candidate. Lula da Silva is stuck at 50 plus, and the others are just trailing back, but far away. It's going to be once again a highly binary and heavily disputed election. Okay, we won't know the results until the very end. From JP Research, we also saw that emerging market retail. Now, retail has been pouring some money in emerging markets, in equity funds, moving average very positive, and some data points here. The size of retail equity fund, the AUM, is increasing for all categories. And that's because they say, and I agree, that job has almost been done, is almost done for developed economies in the sense of cutting rates, and emerging markets are still beginning to move. Brazil hasn't even begun yet, so there's some room for bullishness in risk assets here, okay, because of that. This is the flow of investors on B3, the main Brazilian exchange. So foreigners, green bars being foreigners buying, accumulated on the year is already a good number. Institutional locals have been selling, providing for the foreigners. Personal accounts, they sold a little, but on the year there's still more buyers than sellers, and banks also. It is still institutional players, funds that are selling to foreigners, okay? FX, we had a small outflow the first week of February after having flows in January. It doesn't change the outlook much. The real is still appreciating. Today it moved higher to 555, slightly higher than this. And you already spoke about how foreigners who, when you compare someone who brought money to Brazil and cashing in overnight CDI against funding in LIBOR, their break-even would be much higher, 15 reais per dollar. Now we are trading lower, 525, 526. So there's some big profit in this trade. We use M2, only M2, comparing from different starting points. I made a short video on that. Then the real loses because we created more currency. One unit in 2018 has become 2.6 in Brazil and just 1.7 in the US. But when I use my ratio, which is I take monetary expansion and compare to overnight rates, when the overnight rate is lower than the monetary expansion rate, I call it expansion. And when it is higher, for example, Fed funds is at 5, monetary expansion is at 2. So we are at contraction, okay? And when we adjust for that, then the real, which has been having some sharp accelerations and decelerations, rates, the Brazilian government issues a lot of currency, but then they have to pull the brakes heavily, and so we have this volatile and violent ride to both sides. And when we adjust for that, the area of the US expansion, the red one, is bigger. And using this analogy, the real is stronger and should be stronger. And this is probably one of the reasons why real estate equities keep climbing higher in the US, because they can keep the ratio of expansion positive and small, whether Brazil tries to accelerate and then has to push the brakes heavily. And this gives a good carry for someone who has its currency and lives on local rates. The only problem with that is that your local debts, you increase because the rates are high, also because of fiscal deficits, okay? It's not just a monetary phenomenon, but it is also a monetary phenomenon, okay? I adjusted some graphics. We can see here, like, Blue Mountains is the ratio of yearly expansion of monetary base. We call it the expanded monetary base, almost M4, okay? The red mountains are the current IPCA numbers. Dotted line is the Selic overnight rate, and the yellow line is Brazil real, dollar Brazil exchange rate. So we can see that whenever the government tries to increase money supply and doesn't increase Selic on the same magnitude, market gets suspicious of the currency and starts buying dollars. It happened in 2023-24. See, they tried to lower the Selic rate while bringing monetary expansion higher. They had to reverse it because the dollar reacted, and current inflation reacted slightly higher too. You can see here. This is a closer look. You see, during COVID, we accelerate monetary expansion, leave Selic at the bottom. The currency depreciates, current inflation starts to creep up. Central bank has to respond with Selic hikes, okay? And then there's a plateau. Monetary expansion goes lower, current inflation goes lower, well behaved. But then the government tries to fake the market here starts expanding and reducing Selic, the market says, aha, and then starts buying dollars. They have to reverse once again. Selic goes higher. Now Selic is higher than the monetary expansion rate, and current inflation is receding. But this is the dollar is also receding, but this is very costly to the country, okay? There is a blip here, but I think it's just a problem of the base of last December. But it seems that monetary base expanded at a higher clip. We have to wait for the next month to confirm it. Let's see. Nominal GDP in Brazil is ranging on the 8 to 7% area, so Selic at 15% is also high since at the long term they converged. So that's why we have a bullish stance on Brazilian bonds here. Another highlight, we made a study where we use this PIP-ZAP. It's like a national index for real estate prices in all Brazilian capitals and some other cities. They try to do an index that proxies what would be the price of a median real estate unit in Brazil. I adjust that by the monetary base, and we can see because of that accelerate and break, this is harming asset prices in Brazil, and real estate here is very cheap, especially when you compare to other developed nations. If you live in a developed nation, want to sell your assets and come live in Brazil, you're gonna buy maybe 6, 7, 8 times the piece of land that you have there. I think it's even more, depending on where you are. So to sum up, real estate in Brazil is cheap. This is also real estate price divided by gross income for workers, the total gross income for workers in Brazil. I know it looks a little funky, but I didn't do any seasonal adjustments here, just divided the values, but still real estate looks cheap by this measure too, okay? By inflation for Brazil, 10-year here, this range, 584, 583. Sorry, 588, here's the 10-year, because Brazil is 252 working days. But nominal rates have been going lower, especially for January 27, which is more influenced by monetary policy. Longer dates are more influenced by fiscal policy, so shorter ones are being more affected. Some FRAs here already price Selic in the future below 12%, which would be a 300 basis point reduction. I will release some shorts explaining how we do these calculations. The next slide is we take January 27 DI future. It is trading at 1331, and if my cycle materializes, which will be cutting 50 basis in March, and 75 in April and June, and then another 50 in August and 50 in September, and that's it. Total 300 basis points. We see that the fair price for January 27 will be 12.97, only 33 basis points to be made. Being short this swap here, the future, but it was trading at 1380. So at that point, you had 83 basis points to make. With the same, things didn't change much with the same cycle. Now I think the premium may be too low, too risky to do the trade. It is already very well priced, unless there's some really bad number in the economic releases, but it doesn't seem to be the case, okay? Bovespa, it's blue sky here has been foreigners buying, and when foreigners start to buy, the market becomes small. The entrance door is small because our market has become small during the last years. So it's amazing the impact that they have. Commodities and banks have been the highlight. And when you compare small caps to big mega caps here, mega caps in Brazil are mostly commodities and banks. So there's one beer maker in the middle of them, but we see that small caps are heavily discounted. Once the central bank starts cutting rates, this may reverse, like it did in 20. Here was 2021. 2021 is here. May happen. And we adjust the Bovespa index with everything, with all the appreciation that it has had the past in the recent past. We still get a ratio which, looking at longer dated history, looks like in the middle of the range. I wouldn't short it here. I wouldn't short the index here, and I would wait to buy if it corrects like 10 to 20%. It is possible. We would be going back to this range. Probably the market will probably see this as an opportunity. But I adjusted to the monetary base, so we have a real assessment of where it is now. Here's the same graphic, but a closer look. Middle of the range. This is pure EWZ. It breached this consolidation area. Strong trend. And when you compare to EM on the longer term, you can see that Brazil has some room to appreciate still, just to go back to what was average in the past. So probably the big players are looking at this, and that's the reason that they reversed their shorts to longs. Against gold, Brazil is very cheap, very, very cheap. EWW, which stands for Mexico, also have some room for Brazil to appreciate, to go back to average levels. And against small caps, USA slightly better. Okay. When we compare small caps, that I said are still oversold to rates in Brazil, to the unitary value of a government bond on time. We had this little spike here, but long term we still can go higher, because in this graphic we use the benchmark from Ambima, just for fixed bonds, which have the time rolling effect against the equities that also pay dividends and reinvest. So this is a fair comparison, because it considers the effect of appreciation of both assets on time. Okay, and from this graphic you could infer that small caps in Brazil have a long way to go if there are some productivity reforms for real. Not this populist thing that is going on, but something for real. Okay, and if rates really collapse, we could see those small caps going 50% higher, or even more, just to correct to regular levels. Okay, average levels. Corn have important and very heavy on costs of meat producers. Still very controlled price. A little green bar there, probably marking a bottom, but no reason to be scared here. Coffee also, for those of you and me, myself also like to drink coffee. We are celebrating. Coffee has been grinding lower. And that's it. I think that conclusion here for Brazil is We still have to be buying on the dips along with the foreigners. The foreigners have the big wallet. This phase of the liquidity cycle is good for commodities because the real economy accelerates. The money switches a little bit from financial markets in developing markets to real economy, and that's bullish for commodities. I don't know how this is going to impact the developed markets in the sense of cost push if commodities start moving much higher, but for Brazil it's going to be good. So on the relative, we still like Brazil against the developed markets. It is a trade that has suffered so much in the last few years that we can see sharp corrections like this one, and the trend may persist, okay? So I think that's it. I will say thank you for your audience. And if you have any questions, please reach us. Please subscribe and like our videos. And see you soon. See you next week. Good luck to everyone.